September 2008. Lehman Brothers goes bankrupt and triggers a global crisis. For us, who act as insurance providers of capital market risk, the worst possible market environment. Let us therefore look at the evolution of the volatility risk premium during exactly this phase, from September to December 2008. The subprime crisis is still unfolding. Volatility is trading at 21.8% and we sell a straddle. Here we see how September 2008 evolved. There were two events of major significance. On September 15th, Lehman Brothers is allowed to go bust. The market that was already in a bearish mode crashes. And on September 19th, we observe a massive counter move, which was caused by a short-selling ban imposed for bank stocks in the US and Europe. A short-lived correction that was to be reversed before month end. Of course, we will lose money in such a month. This was a major crisis event with an extremely high realized volatility. Here we see the P&L of our straddle position. We lost 4.1% on the straddle. And in our hedge portfolio, we also lost 0.3% to end up with a total loss of 4.4%. Let us look now at what happens in terms of realized volatility. What we experienced in September 2008 was a market with a realized volatility of 45%. However, we had sold 21.8. Obviously, we must lose money when we sell 21.8 and realize 45. If you think September was bad, wait until you see October. The month actually begins well, with the TARP fund being announced on the 3rd of October. Nevertheless, the market breaks down again as the Lehman crisis now develops into a global trust crisis, infecting more and more markets. In October, the realized volatility we observed in our hedge portfolio was 80%, but we had sold implied volatility at 41.8. Clearly, we again lost money in this month. 7.4% is the loss in the straddle, and in the hedge portfolio we actually made a small profit of 2.2, so that we net a total loss of 5.2%. What we just observed were two major damage regulation events, one following the other, which together produced a loss of roughly 10%. November 2008 was actually quite boring. The realized volatility was at 61%, and well, it's kind of hard to talk about a boring market when you have a realized volatility at this level, except when you sold implied volatility at 60.3 at the beginning of the month. These two values are very close to each other, which means that the volatility risk premium portfolio probably did not make any large profit or loss. In total, it was a profit of 0.7%. In December 2008, markets began to calm down. We sell volatility at 49% and realize a volatility of 45%, so that a net profit of 5.5% is earned. For the first time in a long time, the normal order is re-established with implied volatilities trading above realized volatilities. And this is exactly how the following months proceeded. If you look at this 4-month period as a whole, then that's how the volatility risk premium evolved, shown here next to the performance of the Eurostoxx 50. I personally would have preferred to be a volatility risk premium rather than an Eurostoxx 50 investor. And now, the same thing again in a long-term perspective. This is the evolution of the Eurostoxx 50 volatility risk premium. The short period you see highlighted in this circle happens to be the 4 months we just analyzed in depth. It's a pretty good performance. And if you think that you could only have done this in the Eurostoxx 50, you're mistaken. This is equally attractive on the S&P 500, the DAX, or on the Nikkei, or on any other equity index. What I'm showing here is a composite of volatility risk premiums on various different equity indices with a little bit more history. This is 17 years of volatility risk premium on equities, an impressively stable and steady positive performance. However, I'm quite puzzled about the fact that in our industry, the volatility risk premium in other asset classes is only rarely discussed. Let's change that. This is the volatility risk premium of bonds. It's exactly the same process, but with bond futures instead of equity indices as underlyings. Or the same with currencies. And probably most interestingly is to compare the performance of volatility risk premiums with the performance of the traditional assets like those that you most certainly already own. The lines blending in show the performance of bonds and equities via two very common benchmarks. Frankly speaking, what this outperformance shows is that it is very much worthwhile to include volatility risk premiums strategically in your portfolio. And now, a small excursion, a difficult point. Most people have difficulty in accepting the persistent existence of the volatility risk premium. How can it be that over a prolonged period of time, people selling volatility actually manage to sell it above the realized volatility? Doesn't that require them to know how volatile the future will be? That's actually not the case. It suffices to continuously manage the process of selling and hedging volatility as demonstrated. And why that is the case, I will show you over here. The following analysis requires the development of two arguments. The first argument has a lot to do with the typical evolution of the realized volatility. Volatility is a stationary risk factor. It goes up, but will always come down and revert back to its mean. There is no crisis that will rage forever, and there is no stable period that lasts indefinitely. That's why the realized volatility curve looks a little bit like the sinus curve shown here. The second argument is about how options are priced in capital markets. All option traders, including myself, have no clue about what the future will bring. In particular, we do not know how volatile the future will be. That's why we base the pricing of options not on our expectations about future volatility, but rather on the level of the recently experienced volatility. We have a rear-view mirror that shows how volatile the recent past has been. New options are, on average, simply priced with a spread to this observed realized volatility. Let's draw this process in the graph. We pick a point on the realized volatility curve, from which on we draw a 1-month period, and then we add 3 Vega points. We now repeat this process on various different points of this realized volatility curve, and then we connect all these points so that we obtain an idealized corresponding implied volatility curve. Now we can highlight the profit and loss phases. The profit phases are those where the implied volatility is trading above realized volatility, and the loss phases are those where the opposite is happening. We begin with a loss phase, that is followed by a profit phase, then again a loss phase, and so on and so forth. My aim with this exercise was to illustrate very simplistically that if you continuously sell the same amount of volatility, you will, over the complete volatility cycle, harvest a positive volatility risk premium. Given that, the win phases are bigger than the loss phases. Hopefully, I've managed to convince you about the attractiveness of the volatility risk premium as an asset class. And although I am an enthusiastic volatility risk premium manager, I urge you for caution when investing in short volatility funds. This asset class bears enormous potential for moral hazard. Moral hazard means careless and reckless risk behavior. Before you entrust your wealth to a short vol fund or a volatility risk premium manager, there are a few peculiarities that require your attention. This is what I will discuss in our third and last film. Thank you for your attention.